Hey everybody, it is good to be here today. My name is Brent Moores and time for long options. Today what I want to talk about is looking at past trades, looking at current trades, looking at some potential new trades. These are all paper money examples we're going to be doing here today, but I'm glad you've joined me. And if you're watching live, great. If you're watching on a recording, I'm glad you're doing that as well. Hey, I'm joined in the chat by Barb Armstrong. And in fact, one thing I would just like to encourage everybody to do is after this session, coming at the top of the next hour, we have another session. And that session is going to be getting started with technical analysis. And if you want to brush up on your technical analysis skills, I encourage you to join that session. Barb's actually going to be teaching that webcast today, I think. So you have a treat having her in the chat. She'll help me out. Between the two of us, we'll do our best to get your questions answered. Also, you can follow either of us on X, or actually both of us on X, please. At Brent Moore CS, at Barb Armstrong CS, for additional content throughout the week. Now, it is important you realize, as we're going to talk about options today, options do carry a high level of risk and are not suitable for all investors. And the information today is for general informational purposes only. It is not a recommendation or endorsement of any particular security chart pattern or investment strategy. Paper money software application is provided for educational purposes only for the sake of simplicity. I'm not going to factor in commissions or fees in the trades, but just realize that is something you need to consider. And all investing involves risk, including loss of principal. There's no guarantee that an execution of a stop order is going to be at or near the stop price. Rolling strategies can entail additional transaction costs, including multiple contract fees, which may impact any potential return. Past performance of any security or strategy does not guarantee future results or success. And the paper money virtual trading application will not assign a short option position early. But we're going to be dealing with long options today. And so let me head on over to the Thinkorswim platform. This is the market. Looks like intraday, it's tagging it as an all-time high. I didn't even realize that. If we zoom in, yeah, I guess we peaked out a little bit intraday, all-time high on the SPX. We've sold off a little bit right now, and we're down about 0.25% on the market as a whole. But there we go. So as you're trading options, we're focusing on long options here. One thing that is going to be essential, an essential skill, if you will, is to be able to go back and see what your trades have done, even after they've closed out. So for example, if I go to the monitor page and go to long single options, I can see open trades here, but what about ones that have closed out? Well, the place to do that is on the monitor tab, go to account statement, and then you can go to trade history. Notice there is an order history and a trade history. It's important to distinguish between those two because there's times when you're going to want to see what trades have filled, and there's going to be times maybe the trade hasn't filled and you want to see why. And so what you'll do is you'll go to order history. But what I want to do is let's just go back between now and last week, same time, so last session, and see what trades have filled and see what happened to those. And some will be good and some will probably not be so good, right? And you win some, you lose some. But I'm going to just be focusing on long options because that's the class here, long options. If I look here, I can see the kind of the trades, and I can see, oh, this is an opening trade, first of all. You can also see this was actually a ratio spread I did the other day, or another ratio spread I did the other day. Oh, here we go. We're selling a call. We sold just a long call on AVGO or Broadcom, okay? And what does it say? Well, it looks like we hit a stop. This was a stop order, 2265. So did we do well on that trade? Well, let's see where the opening order was. So I'm going to go down and I'm going to look for AVGO on that opening order, and let's just kind of analyze it and see, could we have done something different on this, or why did we get stopped out on this trade? You may, if you're looking at yours, remember you can change the look back period on this. You can scroll down, and if you got a lot and you don't see it, I can actually see it poking out right here. You can put in the symbol there, and it will narrow it down. And then you can see, oh, those are my AVGO trades. But even if you don't have as many symbols, then you can just kind of go down and look, where was my AVGO? And I'd be looking for an opening trade. Here's an opening trade on AVGO. Make sure it's the same thing, 21st November 25, 340 call. That's what we had on both of those. And we bought this for $37.20. This was the opening trade. We bought it for $37.20. We got out at $22. That was not a great trade. We got in on the 16th. We got out on the 19th. Okay, we weren't in that very long. Must have gone down quite a bit on this. So let's just take a look at our trade that we've done on this. Well, look, the 16th was here, right here. So why did we get in? Well, we got in because the general trend was up, and we got out here. Now, the thing is, I think the expectation we had on this was that, sorry, that's an old drawing there, was that we were bouncing here, that we were bouncing. Well, it didn't really bounce much. It just went down on us right away. And so that's why we got out. Now, if we truly wanted a longer term trend trade, that probably wouldn't have been an appropriate exit, because look, we're still above that 20-day moving average. We still potentially have decent support here. But what we did is we put a stop loss based on the option price. So, when you put the stop loss based on the option price, of course, there's no guarantee it's going to get us out where that stop is. But there's also a little bit of a disconnect there between where the stock is and what that option price is going to be. So we could have alternatively said, hey, here was our support level, and we're going to get out down here or something. In that case, we'd still be in the trade. Now, that may be good or bad. By the time it goes down there, if it does indeed go down there, we'd be losing more. We protected we cut our losses short, so to speak, was the goal on that. But anyway, that was the first trade I wanted to look at there. That one, didn't go so hot on that one there. Let's look for some others here on this. That was Broadcom. Let's look at some other closing trades. Oh, here we had one. AMD. This was we're closing a single option, okay, because Apple was a stock trade. That's a stock trade. You can see that right there. That was a single put. We closed this at 16.45. When did we get in? Oh, here it is right there. We got in at 10.50. So that one was actually a nice gain. We got in on, so we hit some sort of target price, in other words, it looks like. We got in on the 16th. We got out on the 18th. Must have had a nice little bounce between them. AMD, okay? So got in on the 16th, which is, this was a bearish trade. It was a put trade. And we were looking for the bounce right off the moving average. And indeed, it bounced down and it hit our target. And so we got out on that trade right there. So, you win some, you lose some. But that's kind of the skill I want you to do, is to be able to look back at some of these trades and just kind of research them. Because sometimes you're going to be a little confused on those trades as to when you got in, when you got out. Now, there's another one I want to show you, and that is BAC. So, look, we got out of Bank of America. We closed that down. It was a limit price. It's a $50 call, one contract. But let me put this in here. I'm going to put in BAC just because I don't see the opening order. Notice this. We got in with two contracts there. We exited one. I don't even remember exiting this trade. So most of these trades, these exits are just automated exits. Maybe they hit a stop, maybe they hit a target. That, I think, was the case here. Why would we get out of one? Well, this is case in point. why you want to be able to look at your order history to see what happened. Let's look at what we did. On Bank of America, we got in on 9/9, and this was a long call. So let's look at our order history. We're looking at Bank of America, 9/9. Oh, here we go. We entered the trade, 2 contracts. We did a first triggers 2 OCO order on this. In other words, we had 2 different target prices on this. We went up, we hit one of those, that got filled, it canceled one of the stops, okay, one of the exit orders, and now we're waiting for our second target, I guess, is kind of how that looks. Now, if I want to look further at this, I can click on the gear, and I can look and I can read about this and see exactly what price it was going to get us out at. But let's just kind of look at the trade. We did, it was a first triggers 2 OCO. We got in on the 9th on Bank of America, and that's when the order was placed. When did we get out? Well, let's go back here. We got out on the 17th. Okay, so let's go back here. Bank of America, BAC. We got in on the 9th, which is right here. You can see my cursor. It went up. It hit a target. We still have another order on this. And the other order is if we get out above, if the stock goes above 53.14. Okay. Well, where'd we go? We got to 52.88. We're almost there to hit our automated order on that to get us out on that target price. Now, our stop is below 48.30 or so. It would be a shame, everybody, if AMD reversed, our stop's down here, our target is right here, we barely missed our target price, our second price. And it'd be a shame if it retraced all the way back down here. So what I would suggest as a potential ways to deal with that is, number one, we can certainly move our stop up to try and help protect it in case it goes down, knowing even if we do that, the stop doesn't guarantee us we're going to get out at any particular price there. Or we could say, look, we're pretty close to we made money on our first contract on that. On the second contract, we're not quite there, but maybe we just get out of the other contract and take our profit. And I'm inclined to look at that and do that one on this one there, okay? So that's Bank of America. Let's look to exit that trade. And we'll look at that, okay? And Hovis said on the AMD trade, we'll get back to the AMD trade in just 1 minute and we'll look at the actual order there on that. But let me get out of this. So I'm going to go back to my activity and positions. I'm going to go to Bank of America. We've made, this is just the second contract. First contract we made a little bit. We're doing okay on this one too. I'm going to cancel that order. Our orders cancel the OCO group. We're going to do that. We're out of the OCO group. And now what I'm going to do is I'm going to create a closing order on Bank of America, and we're going to take our profit on this. So confirm and send. Make sure you just this makes sense to you. Don't worry about the whole max loss thing. That doesn't make any sense given this. This is as if this were an opening trade. Okay. And if we were just selling a naked call, this is what that is. So on closing trades, these numbers don't necessarily make sense on that. I'm going to look to get out of this. Make sure you read the red note. And Greg says, let it sit, let it cook, let it continue to go. And absolutely, you can do that. I don't begrudge anybody for making that decision on that, but I'm going to take the profit on that there. Now, let's do a couple questions here. First of all, there was a question on the AMD trade. How did we get out of that trade? Well, let's look back at that and let me go back to, because we got out, we know we got out. Let's look at that order history though on, what'd we say, AMD. our order, we got in on the 9th, and let's see, we got in on the 9th. Wait, that was a sold. Yeah, we bought this one, so we're looking at our entry order. And we got out, and the order was to sell it if AMD marked greater than or equal to $165. That's that, or less than $150. So when you go here, which is where we were, it's not going to give you all the information necessarily. If you put in an order-based, rules-based order, which we do all the time in this webcast, you got to actually dig a little bit deeper to look. So we said 165, 150. That's how we got out of that trade, Hovis. So hopefully that makes sense. The AMD trade was bearish. It was a long put, right? It's a long put. So in this case, I think it was a profitable one. The stock went up and, the stock went down and it dipped down below 150, which was our target. So it went perfectly, really. It kissed, got us out, and then it went right back up. So that one actually worked pretty well. Now, Harry said, could we use trailing stops? Yeah, we can absolutely use trail stops. In fact, I think I have another trade that we have a trail stop on. Let me just look real quick on that we closed out of. And let me go back to trade history. Let me get out of AMD. And this one was not successful. There's a trail stop. We absolutely did that. And where did we get in on MRK? Okay, well, let's just do this. We'll go up MRK here. We'll look at this. We entered right here. We got at the trail stop. We got out. It clearly did not go our direction. We were in it for a while, like a couple weeks almost. We got an MRK, Merck, on the 2nd, out on the 15th. Let's look at it. MRK. And let me just refresh myself. What kind of trade was this? This was a long call. On the 2nd, we got in right here. We were looking at this for a bounce. Now, because right now this looks, well, that looks terrible, looks bearish. But if we were looking right here to when we got in, that doesn't seem unreasonable to me looking at it at this point. Okay, we had a nice hold type bounce. General trend has been going up at that point. And then look what happened. Let me go day to day. Boom, went bad day. Bad. It just kind of lingered, kind of sideways for a little bit, but then we got out, and this is where we got out, I think it was the 15th, 16th here. Okay, we got out of that. So that was a trail stop. You can absolutely use trail stops on this. I'd say in terms of our exit orders on these trades, just to kind of sum up this, very often we put it based on the underlying stock price as a rules-based order. Often we'll do just a stop order, which we showed you on AVGO, Broadcom. And every once in a while we'll do a trail stop. I don't do those as often, but we did one there, and there you go. Okay, good. But I wanted to start off with that because I want to show you there's going to be times where you need to do a little investigation. Okay, and that investigation is, when did I get in? When did I get out? Why did I not get out? So you got to delve into the order history, not just the trade history, and you got to be able to click on those gears if you're going to use the rules-based order. Now, those are past trades. Let's look at some current trades here, okay? Number one, well, we just did one. We got out. Bank of America, we decided, hey, we're just going to take our profit on that and run. But there's other trades that you may want to use and manage. I want to look in particular at this one today. Oh, and by the way, let me just mention something. I showed you the trade with where we had first triggers 2 OCO. And some of you I know are listening to me going, I have no idea what a first triggers 2 OCO is. You put in 2 target prices. I have no idea how to put in 2 target prices. On the 9th, on September 9th, I did a webcast on multiple target prices, doing first triggers 2 OCOs and whatnot. I will put a link to that in the chat for those of you who are live. For those of you who are not watching live, if you want to see that or other webcasts, what you do is you just go to the Trader Talks channel, once you're in the channel, go to the playlists, and you can click on whatever class playlist you want. And in that playlist, you'll see on September 9th, I have one that talks about multiple targets and multiple stops. You'll see that there. Okay. Now, Caterpillar. Caterpillar has been a trade we've been in for a while. It's a leaps trade. Okay. It's a leaps trade. And one rule that often I've taught that we don't always adhere to necessarily, but it is an option for you, is to roll out a profitable trade, take in a credit along the way, and possibly lower your risk. And we're going to do that by taking this trade, and once we get up to a higher delta, okay, here we have 88, often we'll say, above an 80 delta or something like that. Now, delta tells us how much the option is going to move in relationship to a $1 move in the stock price. In this case, a $1 move in Caterpillar is going to mean about an $88 impact on the portfolio here. But in this case, it's done well. The delta didn't start out that low. Caterpillar's gone up. If we roll it down, to a lower delta, what it's going to do, it's going to bring in a credit. And once we lower the delta, if the stock does reverse itself and go down, then it's going to be less impactful in a negative way on our portfolio. That's the reason, the rationale for it. Bring in the credit, lower the delta, and try and protect yourself if it goes down. Now there's bad side too. The bad side is, number one, it's a new trade, first of all. So we're selling this one, we're buying a new one. That's going to be commissions, right? Just because we're rolling doesn't save us on commissions. Number two, we're bringing in the credit, but if the stock does continue to go up and we lower the delta, let's say we lower that delta to something like a 65 delta, for example, which is kind of a typical delta that we're using on these trades to enter, then if the stock continues to go up, we're actually going to be making less money if it continues to go in our direction there. Now, Wiley said, what delta did we buy Caterpillar on? I don't know right now. The only way I could think to see what that would be, Wiley, would be this, is you could go to think back. You could research the day you bought this on, okay? What day did we buy this at? We bought this back a year over, sorry. This is the 25th. Several months ago. You can go to think back and then look at the delta on that. But look, what I would say is typically on these, we're looking to buy we say generally 60 to 70 deltas when we get in, okay? And then when we get above, say, an 85 delta or something like that, then we consider rolling. And so what if we roll that? Let's take a quick look at that trade here. Now, one other thing, as we do this, let me just mention this. I'm talking about managing these current trades. We talked about getting out of Bank of America. There's a lot of others. I'm not going to go through managing them all today, but let me also invite you. On Wednesdays, I have a Managing Your Options Portfolio webcast. I'm planning on looking at a lot of these tomorrow in that webcast. It occurs at noon Eastern time if you're watching live. Managing an Options Portfolio. We talk about management a lot, but I want to get into some new trades here today as well. But let me just talk about this. Let's roll this. What am I going to roll it to? Well, I'm going to consider keeping the same thing as long as I'm still bullish. This is a long-term bullish trade. If I look at the chart on Caterpillar and I decide, well, I'm no longer bullish on this, I wouldn't roll it out. I may just get out of the thing if I'm bearish on it. But in this case, I'm just going to go to the same expiration date, which is it's January of 27. And it's a 3:30 call right now, but we're going to look to change that delta. So the question is, what do I roll it to? The answer is, forget about the past trade. Yeah, this trade was great, but it worked out great. But that has no effect. It has no impact on the next trade I'm going to do. Pretend it's a new trade. And what are we going to get in? If I want to do a leap on this, and I'm going to continue to do a leap on this, we said, we went out to this one. I can click, actually, I'm going to sell I have a stop order on this. I'm going to cancel out, I'm going to cancel that stop. And by the way, that is another choice we could do on this. Instead of rolling it, we could just tighten up that stop at this point too. I mean, our option's up 163 right now. Our stop's way down at 93. We could move that stop up. But what I'm going to do is I'm going to cancel out of that stop order. Okay. Now, when I go and I go to trade and we look at that position, you can see the little tag on the position we have. I need some more strikes here on that. There's the trade we have right now. Let's look at some deltas. Here's our delta. You can see our delta right now is about 89. Let me go back down. Normally we're looking like a delta that's between 60 and 70. I'll go between those and decide what we're going to do. What we're going to do, the 450 strike. Okay, it's going to cost us $8,100 for that. That's a lot of money. But we're selling this one for $16,000. So that's going to bring in the credit. So we said, let me just remind myself, 450 strike. Let me just jot that down so I don't forget. Now, we could just sell out of the other one and we could buy this. If you want to do a rolling order, so to speak, using the Thinkorswim functionality, I can just go here. I can right click on it. I can create a rolling order. That's going to say calendar. I'm not going to actually change the date. I'm going to leave this as the January contract. And we're going to change this to a 450 strike. And let me just move this up. There's our credit. $83 credit to change the strikes on this. Okay? To change the strikes. Well, $83, yeah, we've got $83, it's fine. Remember, we got a 100 multiplier on that. That's roughly an $8,400 credit we're bringing into the account for doing this. Now, it's not going to look that great after we do this because it's going to reset this nice PL open. This is why you can't rely on the PL open when you're looking at things. It's going to reset that PL open to 0 as soon as we do that trade. Okay? But there we go. Now, S asked, why this particular delta? Well, look, I've gone through I've spent sessions in the past on rules on these. Typically, we're going a little bit in the money on these, okay? And again, delta tells us how much the option price is going to move in relationship to stock price. But on these, we're going to, the delta kind of tells us how far in the money it is. If I go to something with a 90 delta, we know it's very deep in the money. If I go something right at the money, then its delta is probably going to be roughly 50. We're going a little bit in the money on this, and we're trying to balance how aggressive versus how conservative we are on this. Remember, if we can do trades out of the money and leverage them up, we're not trying to leverage it up as much. I mean, it's already a leveraged trade. There's no doubt about that. But we're trying to, by going a little bit more in the money, it's probably a little bit of a more slow moving trade in terms of the percentage gains or losses. So that's kind of our target on that, 60 to 70. And we just kind of went in between those there. Okay, so what I'm going to do is, now that's showing as a mid price. It may not fill exactly at a mid price. So I'm going to go just a little bit more towards the natural price and see if we can get a fill on that. I'm going to confirm and send, and I'm going to send that order. Okay, we just filled. Now, we brought in that nice credit. When we go over here, here's our new Caterpillar trade. And you can see our PL Open has zeroed out at this point. Effectively, it's the same trade. Now, what I'm going to do is I'm going to say, hey, what I want to do is I want to put in a stop order on this trade just to kind of try to help. It's not a guarantee. Try to help protect ourselves on this trade. So I'm going to do this based on the stock price, and the stock price here, based on, not the stock price. I'm going to do it based on the option price in this case. Current price is $80. $80. We're at about a 65 delta. I'm going to go to about, they're going to do a stop, roughly 65%, about the delta of that trade. So 0.65 times 80 gives me about a $52 stop on this trade. How do I do the stop? I can simply right click on this, create a closing order, just click on it. It gives me this. I'm going to make it a stop order. I'm going to make it good till canceled. And we said $52 on that. $52. There we go. That is going to be our stop. I'm going to confirm and send that order. And just remember, when we put that stop in at $52, it doesn't guarantee we're going to get us out exactly at $52. If Caterpillar gaps down, we could certainly go below that. Okay, so there we go. There's our new trade. There's that. Okay, let's look at, let's see what we got on time. Okay, we got a little time. Let's look at some new potential trades here. Again, if you want to look through some management of other of these trades, I'm going to be hitting some of those up tomorrow in a managing an options portfolio class that occurs at noon Eastern time. Let's look at another maybe longer term trade. Now, I wanted to bring up one in particular that I think can be illustrative of some issues. So here's Newmont Mining, okay? Trends obviously going great. And I'm doing a longer term trade on this, okay? So I'm going to go out to next year on this. So let me go to the trade tab. Now, here's the thing on Newmont. I know this, but you can discover this on your own as well, is when you look at the contracts on this, I don't need that many strikes. Often, these actually aren't that bad, but you see the bid-ask spread on those? They're kind of wide, okay? That's like 40, 50 cents, 40, 50 cents on a $2 option. 40, 50 cents on a $20 option is one thing. 40, 50 cents on a $2 option is a whole different thing here. So sometimes on these, very often on these, if you look at these, you'll go, the spreads aren't very good. So you just need to be aware of that. So I'm going to look out, and I'm going to go out. I don't want to go out. I'm not going to do the whole 2027 one, but I'm going to go out to next year. I'm going to go to March, and I'm just going to double check those. And of course, what you can do is you can look at your open interest to try and help you on that. And you can see, by the way, don't worry about the volume, but I'm going to look at the open interest, and you can see, hey, we have some decent open interest on that, but usually you can tell. Look at the bid-ask spread between not just one contract's bid-ask spread, but look at some around it, because sometimes you get quite a tight one on one particular contract, but other contracts are terrible. That's probably not a great sign here. So what I'm going to do here on this is I'm going to do what we did for our delta on the other. I'm going to go in the money a little bit. So I'm going to use my delta as kind of a guide on that. I'm going to go to somewhere 60 to 70 delta. We'll go 66 delta, kind of in between those. Double check my bid-ask spread. Seems reasonable there on this. I'm going to buy, and this seems reasonable, and that seems reasonable. It's not that, that's fine, okay? So I'm going to buy this, but I'm going to buy the $80 call, and I'm going to put a stop on this as well. So I'm going to right-click on this, and right now I'm going to put the stop based on the option price again. Again, we don't always do that. In fact, very often we don't do that in the class. And we may go through another example here today where we don't, but in this case, I'm going to do that. So I'm going to buy custom with the stop. My delta was around 65. I'm going to use that about the same as that same percentage, 0.65, times my purchase price of $12.40 to kind of give me a stop order on that, which is $8 and change, $8.10. We'll say $8.10 on this. So I'm going to make this stop, go till canceled, $8.10. Now, some of you are going, why? What's with the whole stop level? What level do we put it at? With options, you can't put your stops as tight as you would with stock. You like stocks, you may put a stop like 5% below the current price sometimes. With options, that would be likely very, very too close, much too close. Because options are just more volatile. They bounce around, and it's likely within a few minutes you may just got stopped out of that trade just on a little bounce, intraday bounce. We don't want that. So, and the more in the money you go, though, the probably in terms of percentages, the tighter you can make that stop. The more in the money the contract is, the less percentage volatility you tend to see in those options. So if I'm doing something that's right at the money, okay, let's say we find a trade that we're doing a 50 delta on. Very often we'll look at a stop in this class. This isn't an absolute recommendation or anything like that. This is just what we do in this class. Often we're putting the stop based on the option price. We'll put that stop around 50%, okay? If we go in the money a little bit more, I'll move that stop a little tighter on a percentage basis. And that's what we're doing there on this to try and help protect us. Lauren said, market's pulling back. This is the goal, is to try and help protect us on that. I'm just going to do one contract of this. We've got our stop, good till cancel. We put the order in. I'm going to click on confirm and send. I'm going to make this in our long single options bucket list there. Make sure you review everything here. Max profit is unlimited because it's a long call. Max loss, that does not take into account getting stopped out at our stop, okay? Because if we got stopped out at our stop and we bought it at $12.35 and we got out at $8.10, that would be like a $400 loss, which is kind of what we're expecting, but it's certainly possible it can go down and be at a different level than that. So from that, then what I'm going to do there. Now, what about out of the money? Okay, is what Kevin said. Very often, if you're going, like, let's say you're going out of the money quite a ways in an option, this would be a very aggressive option trade, Kevin. Maybe you're doing something in the 30, 35, 40 delta. A lot of traders will not even use a stop on those, okay? And you may go, wow, that's crazy, not using a stop. These are very, options are speculative trades. I mean, that's what we're doing them here for right now. We can use them for protection or other purposes. But options are much more in the speculative bucket than just your longer term stock trades typically. And you got to know they're going to bounce around a lot. And so if you're doing out of the money contracts, very often we may not even do a stop loss on those. Okay. I don't do that very often in this webcast just because I try and maybe take a slightly more conservative approach on that. I wouldn't call these trades conservative, but more conservative than just kind of shooting for the stars here on your out of the money contracts. There is a survey link in the chat, everybody. And I'm not going to take the time to go through more trades because I just have a couple minutes and I'm not going to be able to, I'm just going to give them short shrift if I do. But let me just show you a couple that I was thinking of showing you. I was going to look at Norwegian Cruise Line, okay, as an example of a trend trade, okay. How far are we typically buying out trend trades, long calls? Very often we'll go 50 to 100 days or something like that in terms of expiration date. Usually just a little bit in the money on those, maybe somewhere in the 60 delta. I was also going to look at, as an example, a potential trade. And these are example trades. They're not recommendations, of course. You can paper trade these if you want. As a potential contingent order, assuming that this trend is going to continue on KHC and looking for a bounce. When I say contingent, I mean we were only going to get in if the stock bounces down and breaks below a certain level and doing a put trade on that. Doing a target price down here, okay? Doing a target price down here. In other words, the target would be based on the stock price, not the option price. And getting out if we broke above here. Now remember, we're only getting in if it shows us a down candle, would be the example trade. That would be more of a swing trade. Swing trades will often go kind of right at the money, maybe just a little bit in the money, but often closer right at the money there. All right, everybody. So what did we do today? We talked about looking at past trades, looking at trade history, order history. We talked about looking at current trades. We got out of the Bank of America trade. We rolled the Caterpillar trade, and then we looked at a couple current trades, potential example trades for you there today. Hopefully that's helpful. Remember, coming up next, we got getting started with technical analysis. Barb is teaching that. Check that out. And please fill out that survey link, everybody. Thanks for joining me today. Have a great rest of the day. Bye-bye, everybody.